Hello everyone, welcome back to Gold Rush Reporter. Today, we're diving into a topic that has been on the minds of serious investors and precious metals enthusiasts alike. The credit system in the US is under immense strain, and some of the most senior bankers are openly signaling that gold is heading higher. Yes, we're talking about names like Jamie Dimon and institutions like Morgan Stanley making statements that, frankly, sound extreme, but they're not exaggerating. When the people who understand the financial system at the highest levels speak like this, it's not hype. It's warning. We've seen deposits leave banks, liquidity tightening, and the Federal Reserve juggling measures to keep the system afloat. If you remember back to September 2019, the repo market spiked dramatically, and the Fed had to intervene to stabilize it. Fast forward to today, and while things aren't exactly the same, the tension is real and growing. Credit is stretched to the limits, and the usual backstops are showing cracks. So what does this mean for you as an investor? Essentially, we're approaching the peak of the credit bubble. And when that bubble bursts, the authorities' only choice will be to keep printing money to maintain the illusion of stability. We're talking about accelerated liquidity injections, similar to what Germany did in 1922. History is repeating itself, and if you ignore it, you'll get caught off guard. Unlike in 1929, businesses and banks today won't fail outright. They'll be bailed out. But the value of credit itself will collapse. Currencies will devalue, purchasing power will shrink, and anyone holding paper promises instead of tangible assets will feel the full brunt of the fallout. That's why gold is crucial right now. It's final settlement. It has no counterparty risk. And it's a real asset that preserves value when credit contracts. The warnings from top banking insiders aren't just hypothetical. They are observing real stress points in the system, and they're urging caution. Governments and central banks may attempt temporary fixes, but these are only delaying tactics. We are in an intermediate stage now, but the end game is approaching faster than most people realize. For anyone looking to protect wealth, the message is clear. Understanding the credit system's fragility and preparing with real assets, especially precious metals, is no longer optional. It's essential. In today's episode, we're going to break down exactly how this credit strain is building, why gold is rising, and what investors should be doing before the next domino falls. Stay tuned, because this story is just beginning, and it's going to get very interesting very quickly. Now, let's get into what's happening behind the scenes in the financial system. The Fed and US Treasury are under pressure like never before. Deposits are leaving banks, liquidity is tightening, and short-term debt is being used to plug long-term gaps. Essentially, the Treasury is rolling over debt with T-bills, short-term IOUs, because no one trusts long-term paper anymore. It's a desperate game of kicking the can down the road. Meanwhile, the Fed's quantitative tightening program, which was supposed to reduce liquidity, has already been halted. Soon, they'll be forced to reverse course completely, injecting more money into a system that is already unstable. Think of it like a spinning carousel of credit printing. Each turn only keeps the system moving for a little while longer. And when it stops, the consequences will be severe. History is instructive here. Look at Germany in the early 1920s. The government issued short-term debt to cover long-term obligations, financed massive deficits, and maintained the illusion of stability until confidence snapped. The US is following the same playbook, rolling over debt, monetizing deficits, and pretending inflation is transitory. The scale today is unprecedented. Margin debt in the US stock market alone has ballooned from around $300 billion a decade ago to over $1.1 trillion. Leverage isn't limited to stocks. It's everywhere. Real estate, bonds, private equity, even crypto. When the cheap money disappears, forced liquidations will trigger cascading losses. Banks will call in loans, funds will sell assets, and the domino effect will hit markets globally. Stocks aren't rising because the economy is strong. They're rising because traders know the Fed will always intervene. Moral hazard is at its peak. The system rewards risk and punishes prudence. And yet, the rules of economics haven't changed. Debt cannot grow faster than income indefinitely. Eventually, the pyramid collapses. When it does, over-leveraged institutions, hedge funds, regional banks, and zombie corporations will be the first casualties. Then pensions, insurance companies, and governments will face the full impact. Public confidence will collapse, prices will soar faster than wages, and savings will evaporate. What about alternatives like Bitcoin? Despite the hype, Bitcoin isn't a safe haven. Its value depends on liquidity conditions, and it will crash alongside other speculative assets. The only real protection is gold, metallic money with no counterparty risk. Central banks around the world know this, which is why they're quietly accumulating gold at record levels, preparing for the eventual collapse of fiat trust. In the next segment, we'll explore exactly how gold is positioned in the market today, what signals investors should watch, and why silver and other precious metals are following suit. The financial stage is set, and it's going to get intense. Now, let's talk about what this means for precious metals and why investors are paying close attention. With the Fed and Treasury trapped in this cycle of debt rollover, short-term liquidity injections, and looming collapses, gold isn't just a hedge. It's becoming the ultimate safe haven. It's no coincidence that central banks, from China to India to Russia, are quietly buying gold at record rates. They're preparing for the moment when faith in fiat currencies fully collapses. Silver is following a similar trajectory, but with its own twists. Unlike gold, silver is both a monetary asset and an industrial metal. Demand for physical silver is spiking, not just from investors, but from industrial use, which creates a tight supply scenario. Combine that with large positions taken by major fund managers, and you have a recipe for rapid price movements. When rumors of systemic instability or manipulation hit the market, silver's volatility spikes even further. Here's where it gets interesting. The credit system's fragility has created an environment where market reactions are amplified. Even minor disruptions can trigger significant moves in metals. The outages we saw in major trading platforms, for instance, amplified speculation and drove silver to near record highs in a very short period. Traders and investors reacted emotionally, rushing into tangible assets like silver and gold, knowing that digital or paper assets could lose value faster than they could blink. And it's not just about buying metals, it's about timing and positioning. Those who understand the flow of capital, the leverage in the system, and the signals from central banks are able to position themselves ahead of the wave. Right now, anyone holding excessive fiat currency exposure is at risk. The moment confidence in the dollar or euro falters, the rush to metals will accelerate exponentially. This is why diversification into real tangible assets is not just smart, it's essential. Precious metals, land, energy assets, and critical commodities can't be printed or manipulated the same way as fiat. They hold intrinsic value that survives systemic shocks. For investors paying attention, this isn't a distant scenario. It's unfolding right now. Next, we'll break down how retail investors and smaller traders can navigate these turbulent waters. Which strategies are practical for protecting wealth, and how to avoid the pitfalls that many fall into during periods of extreme volatility. The choices made now will determine who thrives and who gets left behind as the fiat system continues its unraveling. So now we're at the point where action matters. It's one thing to understand the collapse of the credit system and the inevitability of fiat devaluation. It's another to actually position yourself correctly. For most people, that means taking money out of highly leveraged or paper assets and moving it into tangible, unmanipulable wealth. Precious metals are front and center here, but don't stop there. Energy, farmland, essential commodities, these are all parts of a portfolio that survive systemic shocks. Timing is critical. Silver and gold aren't just rising because of panic. They're rising because of fundamentals. Industrial demand, central bank accumulation, and the fragility of fiat systems are all converging at the same time. Anyone waiting for a perfect moment risks getting caught when the next wave hits. The moment is now. Look at leverage in the stock market. Margin debt is at historic highs. Speculative bubbles in tech, AI, and crypto are inflated by cheap credit that is being withdrawn, quietly, behind the scenes. When liquidity tightens further, the unwind will be brutal. Equities will cascade downward, forced liquidations will accelerate, and panic buying in real assets will spike. If you're not prepared, you'll be scrambling to get into safe havens at the worst possible time. We also have to acknowledge the role of governments and central banks. They will intervene, yes, but only to stabilize markets temporarily, not to preserve your wealth. QE will return, T-bills will be issued, liquidity injections will continue, but all of this is just delaying the inevitable devaluation. The real winners are those who step out of the system before it hits the tipping point. And here's the critical insight. Physical possession matters. Paper gold, ETFs, or digital claims are subject to counterparty risk. When the system is under stress, access to actual metal becomes vital. Think back to 2025's silver market spike. Availability mattered, and those who had physical metal were in the strongest position to capitalize. This is a unique moment in history. We're not just watching markets react. We're watching a global reset of monetary trust. Currencies, bonds, and leveraged instruments are on borrowed time. The shift toward tangible assets is inevitable. Investors who recognize this and act decisively are not only protecting themselves, they're positioning to profit when the fiat system rebalances or collapses entirely. Now we bring it all together. The story is clear. Fiat currencies are fragile, credit markets are stretched to the breaking point, and central banks are trapped in a cycle of printing and intervention that can't last forever. The reality is harsh, but actionable. First, you must move your wealth into real, tangible assets. Precious metals like gold and silver remain the ultimate safe havens. They have no counterparty risk, retain intrinsic value, and historically outperform during periods of monetary collapse. Physical possession is key. Don't rely solely on ETFs or paper claims, as these carry risks when markets seize up. Second, diversify into other non-printable assets. Productive land, energy resources, and essential commodities will hold value even when currencies falter. The goal is to maintain purchasing power, not just chase nominal gains. Third, be aware of timing and leverage. Avoid overexposure to debt, margin accounts, or speculative instruments. The unwinding of excessive leverage will be swift and unforgiving. Fourth, watch for market signals. Keep an eye on interest rates, T-bill issuance, central bank announcements, and derivatives stress points. When liquidity freezes or fails in one area, others will follow quickly. Awareness is your first defense. Finally, understand the global perspective. While the West clings to digital fiat systems, the East accumulates tangible assets, including metals. This isn't speculation. It's preparation for a reset that is already in motion. The disparity will define winners and losers when the next financial shock hits. 2025 has been unprecedented for silver and gold, But this is just the beginning. Those who act decisively now, moving out of leveraged instruments and into real physical assets, will not just survive, they will thrive. The takeaway is simple. Think in real terms, hold tangible assets, and stay alert. The fiat system is ending. The age of real, accountable money is returning. Stay connected, stay informed, and protect your wealth while others chase illusions.